Welcome to TheoTrade. This is Don Kaufman. It's May 30th, 2019, and you are watching the TheoTrade evening video. Well, I'm going to start with what I term is on the edge of expected. Here we are on a Thursday afternoon coming into, of course, tomorrow's Friday trading session, and we are right on the edge of what I term expected. And what I'm really referencing is, again, the expected move. I was talking about this in last night's video. I'm going to harp on it again because that's what's really driving the markets. You know, people fail to see, oh, it's this stock driving the markets, that stock. Yeah, but it's hedging activity that's really driving today's marketplace. And when you take a look at the SPX, it becomes incredibly apparent. So for those of you unaware, the expected move, again, it's based on the options market, right? The options market, for example, last Friday kind of depicted the risk this week. And again, this is a shortened week. The market was supposed to move up about $47 or down about $47. And here we are right on the edge of expected. In fact, if you take a look at this on an intraday basis, this is an intraday chart on the SPX. I'm going to go ahead and just close up that left side bar so you can see a little cleaner. Here's yesterday's trade. We're literally skimming the edge of the expected move. Okay, today's trade, we break out, we come down, we touch the expected move, rip back up off of it. So that's why I say, hey, we are right on the edge of what is anticipated, what is expected. Now, why this makes such a huge difference? First of all, the options activity, the SPX, it's the mother of all products. You know, when you look at like net, the liquidity that trades through the entire market. I mean, today wasn't exactly like a blistering trading session, right? The S&Ps did decent volume, but look at the SPX. The SPX does 1.2 million contracts. You have to realize that in an average day, the entire marketplace, the entire, equity options, index options marketplace only does about 17 to 18 million contracts, but 1.2 million of those are SPX. And this contract is like what? 20 times larger than everything else. And then you also realize other contracts like the spiders are, it's the exact same animal as the SPX. And then when you start looking at the contract size that's trading in the spiders, well, that's good for what? 2.7 million. You realize you got 2.7 million plus, 1.2, 1.3 million. We're already up to basically 4 million contracts, and we haven't even talked about the VIX, which is basically based on what? Well, the VIX is based on the SPX options. That's good for another 300,000 contracts. It's kind of a light day. And you start to recognize how much, liquidity really rests on the back of the SPX. So why am I harping about the SPX? Because SPX has no underlying stock. You can't buy it like what? Instrument's not tradable. You can't sell it because the instrument's not tradable. So what's used as the hedge against the SPX? It's the S&P futures. Now, what this effectively does is it drives us within given ranges. We call those given ranges an expected move. Now, again, people get lost like, okay, so how does expected move? Listen, every single option traded in the chain, right, is all related to these expected moves. Every single option in the chain is related to the expected move. That's how you derive the expected move. It's like an average, if you will, of what's anticipated in the marketplace. So the weekly expected move carries the most weight. In this particular case, obviously, this is carrying weight. I can't stress that enough. We can even back up a couple of trading sessions in here, if you will. This is going back to like a 30-day, 1 hour. Look at the last 3 trading sessions. The edge of the expected move, the edge of the expected move, the edge of the expected move. Yes, we can breach expected once in a while. But the edge of the expected move is just critical this week. So the question kind of looms for this Friday trading session. If you're to go under the expected move, and again, I don't want you to think for a second that we can't cross under the expected move, because that's a complete and utter fallacy. But what's going to happen is if we do start to really cross under the expected move, the marketplace is going to accelerate to the downside because hedging activity would drive traders to sell. Why? All right, this really breaks down to the fact that lots of traders buy straddles, some traders sell straddles, but more often than not, traders are what we term short gamma. And the short gamma trade forces you to trade with the direction of the market. So if the market's heading down, traders have to sell into the selling. So markets start to sell off tomorrow, and things can get really, really violent, especially on a Friday. But if you look at the probability of this, the higher probability states that we stay inside of expected. That's important. Okay, I don't want you again to believe that there's some directional bias taken away from this, because there isn't. The higher probability, we stay inside the expected move. The lower probability, we break outside of expected. But if we break outside of expected, things can get, well, hideous, and hideous in a hurry. Now, the question is, like, what do you really anticipate out of this? Well, you know, we're right on the edge of the expected. But one thing that I think really, I guess, it looms large with me is the financials. The financials today, they're weak on a relative basis. Actually, you know, you look at the S&Ps, and the S&Ps closed up 10 today, right? We're just, you know, about an hour and a half after the close here, but the S&Ps ended up 10. The Nasdaq finished up 38. When you look at the XLF, it's weak on a relative basis. In fact, okay, look at a couple things. So you've got a marketplace that ends up with one of its primary sectors that's really driving a lot of the order flow, down 0.3%. You also got to be aware, this is the monsters of tech. It was only up 0.3%. So those two are almost equivalent in size. They kind of canceled one another out today. Okay, but then you had the energy sector, and it's been really, really weak lately. I mean, that's kind of an understatement. Oil got hammered by the tune of about 4%. But take a look at the energy sector. It's getting killed. You almost have to step back from the market and go, what's holding this thing together? Like, what's actually holding the market together? And there's an answer for that. It's stocks like Intel. In fact, I highlighted Intel yesterday as the possibility of a bounce. Things like what? Right here we have the information technology sector, real estate, which by the way is construed as defensive, okay? And a handful of other sectors that we don't often talk about, like industrials are up a little bit today, consumer discretionary is bit a little bit today, energy obviously is getting killed, but it's interesting to see financials, energy, okay? And over here, communication services that are down on this trading session. So for the most part, this session today, I think it's a wash. I think you have to put it aside. I wouldn't read any deeper into it whatsoever. The other aspect that still holds true, I'm almost getting sick of talking about it, the bonds. Okay, the bonds continued. Yeah, it's a launch trajectory at this point. I mean, again, at some time in the near future, I won't want to step in and short these bonds. But between you and me, not home yet. We're not home yet. I think I got the bonds in the 154, even 155 range. I mean, the 10-year interest rate, take a look. If there's ever a time to refi, come on. The 10-year is sitting at 2.2, okay? But if you start opening this on a longer time frame, and I think you do, you have to go out to like a 3-year, okay? You could easily drop to 2% before this is all over. Nevertheless, and again, being a little facetious with the refi, but come on, the interest rates are down there, people. But let's also look at a handful of other products in today's trading session. So as I said, the financials, they're actually under what I would term the Maginot line. And I really do kind of dub this the Maginot line. Anything under 26.50. I don't care if it's a penny or two under 26.50. You can see they're at 26.41. This is bearish for the entire marketplace. Okay, the markets right now, I mean, they're on the edge. And one of the things, though, that again kind of really resonates with me, I know I'm on a 3-year weekly, I'll open this up a little bit further. One thing that really kind of sits with me, though, so I'm like, oh, the market's on an edge, but at the same time, they appear to be wildly in an oversold condition in the short term. So, you know, it's a Friday, maybe we bounce back up. Again, in the back of my mind, I'm thinking about that expected move, okay? But the thing, again, that I would say also looms really large. Not only the financials kind of breaking down, the S&Ps look rough over here. The thing that really looms large, volatility is just not participating. Okay, volatility is just not participating. I mean, the entire month of May, we've sold off. Let's look at the spiders for a second. Let's clean up everything. We're going to take a look at the spiders. The spiders gives you a cleaner take. I mean, the sell side activity literally started on May 1st, and it's persisted. The month of May is going to end. It's going to be the ugliest month thus far in 2019. Okay, put that aside for a second. The volatility, it's just not participating. Look, the volatility spiked. We're substantially lower. We're substantially lower in the S&Ps than we were, for example, on May 9th. The volatility is also substantially lower. Okay, we are right now. Okay, when I say on like pins and needles, the one thing you're gonna see if the marketplace starts to sell off at all, the big confirmation is going to come out of volatility. Volatility is just going to get downright angry. Now, I'll reiterate what I talked about last night, and that is simply you got to kind of pick and choose. In this marketplace, you have the S&Ps, they've had a pretty good sell-off. I mean, again, you look at this, on like a year-to-date percentage, the S&Ps were up some 18%. Now they're only up about 11%. Again, we might be overdue for a bounce, neither here nor there. You start looking at the Nasdaq. The Nasdaq was up 23%. Now it's only up 14%. You're staring down the face of about a 10% sell-off in most of your major products over there. Of course, if you take a look at the financials, and I've been pointing this out a lot, the financials are up about 17%. They're only up about 10%. The financials have actually sold off less than the broader market, less than, of course, technology. There could be room to the downside inside of the financials. Last but not least on this front, you got to look at our little friend, the Russell, which was up about almost 20%, falling about 10%. Again, everything is moving in relative tandem. So the name of the game right now is to find specific sectors that have been absolutely, whacked lately. You take a look at something like, again, emerging markets here. Emerging markets was up, almost 15%. Actually fell flat on its face and almost went negative. It's already on a little bit of a bounce. I was talking about Intel, Intel, now if you already missed this one, it basically happened already. We mentioned it literally last night. Things up 25%, falls flat on its face. We're actually down on the year. We expect a good and decent sized bounce. Intel wouldn't surprise you to see the bounce. Don't get carried away. 47, 48, but you use like an in-out spread to take advantage of that. Again, there's a number of stocks that have been hit hard. So we're looking for long and short positions. I'll reiterate, possibility of a short position inside of Walmart, especially on the heels, and you'll see Walmart right now, it's offered pretty much where it closed, especially on the heels of the fact that Costco came out with earnings this evening. Costco earnings, they actually, they beat, but revenue was pretty much in line, but the stock happens to be down. That could actually pull down, both consumer discretionary and staples, if you will, could have a degree of risk. A lot of the retailers taking a little bit of heat, though, some of the recent trade. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.